Hello, everyone. I'm Gene Massey with MediaShares, and today we are doing a very important webinar called Crowdfunding Exits. And it's all about these numerous crowdfunding issuers today and how do their investors get their money back, or one way they can get it back. And we have a really great panel of experts, and I'm going to let everyone introduce themselves, starting with Rebecca, the CEO of Dealmaker.
Hey, Gene, thanks for having me. Hey, everyone, great to be here with you this afternoon on this amazing, important topic that I think is really under discussed. My name's Rebecca. I'm CEO and co-founder of Dealmaker, self-hosting platform for Reg A and Reg CF, transacted over 1.7 billion in capital.
And Sarah?
Hi, Sarah Hanks, CEO of Crowdcheck Inc. and managing partner of Crowdcheck Law. And the two of them together provide a wide range of legal compliance, diligence, and disclosure services for all of the online exempt offerings.
And Andy?
Thanks, Gene. Thanks, everybody, for having us. I'm Andy Kizik. I'm a Senior Vice President of Advisor Relations with OTC Markets Group, which is a interdealer quotation system, which actually acts as a market for companies to trade on that are not necessarily SEC registered, but also a lot of Reg A exits.
And Joe?
Sure, Gene. Thanks, everyone, for joining today. I'm Joe Altmans, OTC Markets. A little background about myself. I have over 20 years capital markets experience. I've been at OTC here now for 13 years. I run our domestic business here. Prior to, I was with Amex for roughly 10 years. And glad to be here, and I'm looking forward to the webinar today.
Great. Thank you all. Now, Rebecca, I'd like to start with you because your firm, Dealmaker, has a number of very successful offerings. You are very well known for that. And I believe some of your companies have gone into the public markets. Would you tell us a little bit about some of your success stories?
Yeah, thanks, Gene. Big reason why we wanted to put together the webinar for all the folks in our ecosystem today, right? Because we have so many people who are having a lot of success raising. And then now kind of for the founders and the issuers who are our main customer, it becomes time to think about, okay, what's next? And so, our partners at OTC are here to tell you a little bit about that as an option. But it's a question that's on everybody's mind because from the stats we've seen between 2014 and 2019, over 10% of the companies who have done regulation crowdfunding have now seen exits. So this is an industry that's working. It is an industry that's raising a lot of capital and getting people good returns. And OTC is a great way that there is an opportunity for some people who are raising capital to have liquidity. We have a number of clients who have raised while on the OTC, or we have folks like Gage Cannabis who did a $50 million Reg A plus and then went and listed. So I can talk a little bit in detail about some of those stories now, or we can kind of hit on them as the questions come up. Worksport being another Reg A offering done by an OTC issuer, raised $4 million in less than 2 months, and then increased their listing size capacity.
So that brings to light a very important question for all of this, because a lot of companies are out there and they raise some money under Reg CF, and they've got a few $100,000, or they've got a couple of $2 or $3 million under Reg CF. So they probably want to know, is this something that they can do or not? So Andy, if you could tell us what type of company would be acceptable to OTC. I mean, what are the requirements? I mean, if I've got a couple of $100,000, can I list, or do I need several million? And so can you kind of give us an idea of what your requirements would be for a company?
Well, sure. Thanks, Gene. And I might tag team on this question with Joe a little bit on the overlap, but primarily when a company wants to be quoted, we've established eligibility requirements in our markets. OTC Markets is divided into 3 tiers. You've got a premium tier QX, which has financial and corporate governance standards. You've got OTC QB, which really has corporate governance standards, and it's emerging in venture market. It only requires a 1 penny bid. And then you have Pink. exiting out of a Reg CF would basically require two things. One of the important factors is really to have a 10% free float to be eligible to be quoted on OTCQB or OTCQX. And the process is really having the ability to have good disclosure, which we would recognize the Form 1A. We have different reporting standards. We have several of them, but we actually created a specific Regulation A plus standard, which is really good because we use the operating document as a primary basis. And then for any subsequent reporting, we could rely on that. We have a disclosure place in our space called the Disclosure and News Service, which is where companies can post and disclose current and ongoing reporting. So what happens is when you're in a Reg CF, you're really in more or less of a restricted type of an offering. So how do you turn that into a publicly quoted product on a stock market, which can be traded through your broker dealer like a Schwab or a Fidelity or a TD? So, the first process is to determine the eligibility of the company. Can it meet the criteria? And I'll let Joe jump into some of that in a second on the specifics. But really, the issue is really to become tradable. So I'll get a little bit into the trading, but it's traded by a market maker or a broker dealer who publishes a quote. Not unlike other markets, but you really have this process where you can put in an order, it gets routed to a market maker who publishes a price. And that process of determining a price is something that OTC Markets can review under the amended rules of 15C211. But I just want to turn it over to Joe for a minute on the specific qualification pieces for a company who's saying, how do I move next?
Thanks, Andy. I don't want to, dive too into the weeds of the different requirements for QX and QB. But for those listening, our website is very comprehensive. Everything with QB and QX is on there. So just go to otcmarkets.com. But to build on Andy's point, our disclosure, our requirements for QB and QX are built more around disclosure, not so much financial metrics. So that said, in terms of qualifying for OTC QB or QX, it's more of a disclosure, I would say, based requirement. One thing Andy did point out, though, is distribution. So we do require 50 round lot holders and a 10% free float. But over and above that, the basis for qualifying for the higher levels here is disclosure and corporate governance. So again, I hope that helps. But again, the requirements are all on our website. If there are any questions, feel free to reach out.
Well, Sarah, this is going to be your department here. I'm sure that listing is just a piece of cake. You just file something and send over your stock, right? Or you want to go through the process for us and tell us what's involved?
Yeah, I mean that could take the whole of the rest of the webinar. So maybe I'll sort of skip through to the big things. But the one thing I wanted to build on what the OTC team was talking about was, as Joseph said, it's disclosure based. One of the things that we see with Reg CF, where, and I'm going to be the broken record, the wet blanket, there is so little compliance in the post offering CF space that most of the companies who've done a CF and not gone on to do a Reg A, many of those companies, they have obligations to file annual reports. Those do not have to be audited or reviewed, but they do have to be in US GAAP. Many of those filings are not. Those guys are not going to manage to make it onto the OTC. So they shouldn't think that just because Reg A says, just because the OTC regs say, hey, Reg A is great, come on and be quoted with us, that it works for CF. And that's the big difference between the exemptions. Reg A has absolutely set ongoing reporting requirements, annual audited reports, semi-annual unaudited reports, and those are acceptable to go on to OTC. Guys who did accredited crowdfunding under 506C, or who've done regulation crowdfunding offerings they're probably going to have to do more in order to meet the OTC standards. And that's going to be the biggest gating issue for any of them. First, work out what are you subject to now. Reg A, just off you go. But if you came in through the other exemptions, you are probably going to have to do a whole lot more work, including auditing and getting financial statements that actually comply with the requirements.
So Sarah, since there are so many Reg CF offerings, and every little company would probably be very interested in listing, I had a broker say to me, heck, we can take anything to NASDAQ. We could even take a Reg CF company to NASDAQ. So, what would be required, in your opinion, for a Reg CF to try to list on OTC?
All right, so I'm going to split the world into listing and quotation. Because OTC is quotation, you do not have to be a fully SEC registered company to go onto OTC. You do have to meet their standards, but Reg A will do. And I've always been an advocate of Reg A. Ongoing reporting is quite enough for any kind of informed investment decision. And it should be for registered companies, but that's a separate issue. But if you are going onto NASDAQ or the New York Stock Exchange, you are going to have to become a fully registered SEC reporting company with 10Ks and 10Qs and Section 16 reporting, which is everybody who owns more than 5% of your shares got to file stuff. This is huge. And I am frequently talking to folks who have aspirations. I'm like, you're two dudes in a garage, and we're not even counting the dog, and you want to go onto NASDAQ, it's not happening. And one of the first questions, for, when should a crowdfunded company go public is when they are ready to do ongoing reporting on a timely basis. So in theory, everybody could go up to NASDAQ, but they are going to have to be ready with PCAOB accounting standards and ready to file on a quarterly basis, because the first thing that happens with some of these companies is they get onto the exchange, they get onto the SEC reporting system, and the first thing they file is an NT, which is we are not ready to file the report that we should have filed. So go public when you are ready to go public, not when somebody says it's possible.
Rebecca, I bet a lot of your companies would like to go public or not go public. What have you found kind of taking the temperature of these companies? Who is excited about it and who wants to do it and who decides they can't do it because it's too complicated? Can you give us a little color on that?
Yeah, I think of it in terms of revenue thresholds. I mean, I think of it exactly how Sarah described. I once had a banker tell me, no company should be going public with under 20 million revenue. And depending on the company, even that could be a little bit low, depending on the complexity of the business, how sophisticated the finance department is, how many years they've been doing audited statements for, whether they're ready to write and management, disclosure and discussion. So there's a lot of different components to it that the C-level suite really needs to think about and take into account, how robust your internal controls are. And a lot of this will depend on the business. I think in a lot of respects, if it's a simpler business, a lot of that is easier to get up and running than a more complex business.
Now, Joe, we've all heard the term 15C211, that's some kind of magic document that allows me to become public or something. We all hear about things like that. And there apparently are some amended rule for 15C211 can you describe that and describe that 15C211 process for us?
I think I'll punt this one to Andy for a bit of OTC, Gene. But essentially, the rule went into effect, over a year ago. And really, it's allowed us to onboard more IPOs onto our market. But Andy, I don't want to go on. Why don't you take it from here?
Yeah. So prior to September 28th of 2021, for a company to be publicly quoted on our market, a broker-dealer had to file a form with FINRA to get clearance to be able to quote a stock. That rule changed after that, where it's been simplified. And the new process is one where OTC Markets has been granted what I think that we could call almost a superpower in a way, to be able to determine that a company's disclosure is thorough and makes it eligible to be publicly quoted by a broker-dealer. This puts the OTC Markets compliance team into a position where we can get the required documentation. So in the form for a Reg A, let's say Tier 2, we could look at the form Reg A 1A filing. We could use that as a basis for a review with some additional bits and pieces. And our compliance team, after conducting some background checks and some normal listing quotation process procedures, we can determine that it's eligible for quotation. That means that once we do that, any registered broker-dealer can, what we call, jump in the box and publish a quote. That quote is generally an indication of interest and a solicitation. So it could be, depending upon how the deal is priced, let's say $5 by $5.05 by a bunch of brokers who are quoting the price. And that's actually a solicitation. So you can actually then go into your account, put in a limit order, and actually execute, put in an order to get a trade executed. This has really simplified the process, but it's also given us a control measure of how we can interact with the companies and have proper disclosure publicly available. And then on the ongoing points, Sarah mentioned that company has to remain current. It's one thing to get the money from the Reg A deal, season through a portal, and then move into a publicly traded market, which is broader, which is an open market. So any accredited or non-accredited investor, mostly retail, can buy 100 shares. And the change in this rule is evolutionary because it really updates an outdated law to simplify the onboarding process for a company to be publicly quoted. The only caveat that I would say for corporate issuers is that when a company is eligible for quotation, they should probably be establishing some existing and parallel relationships with brokers to just jump in the box. There's no broker review from FINRA. It's really the ability to quote. There are some limitations where if a broker doesn't quote the shares for several days, a re-review has to take place. So we will determine that the company is eligible for quotation and turn on the lights, so to speak, but it does require some work on an ongoing basis from the corporate issuer.
I've heard this phrase, market maker. So, and I want to know if I'm going to put my stock somewhere. I've heard of market makers doing bad things and taking advantage of issuers. And how do I get a good market maker? And I'll throw that out to anybody.
I'll take a stab at it, Gene.
Okay.
So there are over 100 different market makers that trade OTC securities, from big to small.
Would I just call them up on the phone and tell them I've got something? Is that how it works?
Maybe
a special
30
filing
years ago. So I mean, in terms of contacting a market maker, you have your boutique firms, right, Gene, your smaller firms, and you have your large wholesaler firms that are very obviously hard to get a hold of. But in terms of a market maker, going back to, I guess, the traditional sense of it, in going, say, public on our market or doing an IPO on NASDAQ or NYSE, your underwriter in most cases is kind of, your market maker. The way our market works is that
let me interrupt you there. So whoever, let's say that I'm with a broker, that broker could be my market maker on an ongoing. So
not every broker is qualified to be a market maker with FINRA.
Ah, okay.
So they're two different things. But in terms of market makers with our platform, what's nice is that once a security IPOs onto our market, it's what's called piggyback eligible. It's a trading expression, but essentially it means that once a security goes live on our market, any of the other market makers that trade through our market can then also make a market in that security. Prior to the amended Rule 15c211, only one market maker kind of owned the security for the first 30 days once an issue in public on the OTC. So nowadays, looking at the new rule, it really creates more liquidity in the OTC market, being that everything now is piggyback eligible upon being quoted the first day. But one question we do get, Gene, that's a requirement I know for NASDAQ is do you have to maintain a market maker once you're on the OTC? And the answer is no. Once you're on board, like I said, you're fully what's called piggyback qualified. Anyone can quote you, going forward. To Andy's point earlier, he mentioned about having kind of a broker in your back pocket. Yes, for small companies and for small microcap companies, when there isn't much natural liquidity in the market, it is good to have a market maker or a broker that you do speak with regularly, in my opinion, again, just to kind of, better understand the trading in the company's stock, the supply and the demand.
Here's a really good question for Sarah. Sarah, I'm an issuer, and I've been working all these years, and I built this company up, and I want to list my company's shares so that I can get some money. And I want to know, how do I do that? How is it possible I can just sell some of my shares as the issuer so I can get that 20 million I've always been looking for? I mean, what do we do about that?
Well, the thing about the founder or any affiliates of the company selling, in order to be able to sell, those securities are what they call restricted. And hopefully the transfer agent will have some kind of legend showing that these securities are restricted. Those can only be sold if that restricted status is removed, which involves getting an opinion from counsel saying that these have been held for the appropriate amount of time, they're being sold in the appropriate way. There's a whole bunch of conditions that you have to go through for both restricted, and these are control securities. So there's limitations on how often you can sell in any given period, and you're going to need a lawyer to bless that process. Without that, you can't do anything. And one thing I want to do here is there are lawyers who can give those opinions, and OTC, bless them, have a list of bad lawyers on their prohibited providers. I was using it last night and found a company that had 2 in a row from that list. Make sure that if you are getting an opinion of counsel, you get an opinion of counsel from somebody who's not on that list.
I know you're not an auditor, but you probably know about this. If I have, I know there's some discount auditors, and they may lose their PCAOB qualifications. What happens to the company and the stock if they lose their PCAOB certification?
Well, I mean, that's really going to be a question for fully public companies. The Reg A does not require PCAOB, only AICPA standards. It's fully public companies who need to be PCAOB, and there will be a prescribed process for changing the counsel. They will need, changing the auditors. They will need to make filings with the SEC saying, these guys are no longer our auditors, and here's the new guys, and also summarizing whether there were any disagreements with the old guys.
Well, Andy and Joe, this is a tough question. How do I keep my stock price from declining? What do I do? What makes the stock price stay up or grow? Can you tell me your opinion on that?
Sure, I'll dive in. I think there's 2 things that a company needs to think about when they want to go public. They have to manage their operating business, which is basically you've got to execute your strategy. A lot of companies always ask me that, and then you have to manage the financial side of it. So when you look at a company, I get this question a lot where I want a lot of volume. Okay, I want a lot of volume because that's going to attract attention. Well, that's going to require, if you want to get a lot of volume, re-educating a new group of shareholders to try to come into your stock, because if somebody sells, somebody's got to buy. Usually in many of the micro cap, nano cap companies I've spoken to, 3 or 4 guys in management with an outsourced team. They've got to produce their widgets, as we say, and then also have to talk to investors. It's complicated. So the focus on profitability and growth has been a pretty good formula for many companies. You know, our market is really a negotiated market with brokers. It can move quickly, but at the same time, you know, you might not have the same type of exposure to index volatility as you would maybe on a national U.S. exchange like NASDAQ or New York. So the process here is gradual. Okay, it's establishing that process. There may be some benefits to better valuation depending upon certain markets. I think it's my belief that the more transparent you are about reporting information, both material and non-material information to the market, being transparent, those are added values to allow the investor to take the risk and determine what type of security they want to buy. And I think that that's been an important cornerstone to disclosure, good disclosure in the market. So are you going to trade better or not? We've seen some indications in some studies that from foreign markets, if you go into the U.S. and you distribute better and you educate better, there could be a slight benefit. We've seen some studies for OTCQX, which have indicated overall that there's some benefits to valuation. But I'm not here to purport that, oh, you're going to do X or Y in terms of your growth. I'm focusing more on making your information publicly available for the investor to trade those shares. And if you execute in general terms, you have a better chance at improving your valuation. Anybody want to add something to that, Rebecca?
Yeah, I just want to jump in there because, Andy, I think some of what you said answered Scott's question in the chat earlier about pre-revenue companies going public. I think there's a whole different business model where you've got mining companies and such where, you know, you're doing a huge amount of investment before you're going to be revenue generating. And I think a lot of what Andy was saying applies, right? You've got to think of, okay, if that's your business model, I think of that differently than revenue generating companies, but you got to have the finance infrastructure and that trading infrastructure and all of that. You've got to really want that to be part of your method of capital raising and budget accordingly.
Now, you may not know what the term IR means. So investor relations, if a company calls me and they say they're an IR firm and they just saw that I just listed, why would I want to hire them, and how do I know if they're any good? Joe or Andy?
I'd say, so investor relations firms, I think, are engaged for a variety of different reasons, whether it's maybe helping out with press releases, right? Or it's maybe some road shows, maybe investor introductions. So I think it depends what the need is. I think IR firms market themselves a little bit differently depending upon what your needs are. But, you know, timing is everything, you know, and I think when you have a good story to tell is a good time to engage an IR firm. All because you say list, whether it's OTC or NASDAQ or NYSE, I don't think is a just enough reason to absorb an IR expense. I think timing is key. But like I said, IR serves a great role for small public companies. They need the extra help. They need the extra introductions. And so for any company looking to further grow into the public markets, if you are small, yeah, I do encourage seeking help from the IR professionals.
Yeah.
Do you want to add anything, Andy?
Yeah, I was going to jump in because I think that to the point Rebecca made earlier about, you know, pre-revenue companies is that it takes a lot of effort to get to that place to become a public company. Okay. I get a lot of calls that say, hey, I'm going public. And I'm like, okay, let me talk you out of going public so you can convince me you need to go public. Okay. And I think that engaging an advisor that focuses maybe on helping put guardrails up for you to meet certain execution points, maybe creating a 1 year, a 3 year, even a 5 year strategy is critically important. You know, you think about research, you know, a lot of microcap companies, you know, they're not covered, right? So they have to engage in sponsored research. One of the things that OTC did a few years ago was we established a premium provider directory, which actually establishes a vetted group of service providers for investor relations, attorneys, you know, for IR firms, for research houses. when you regurgitate the message to an analyst and that analyst writes back what it is you're trying to say, that's generally pretty good research. And I'm not making a judgment on research here, but you want to make sure that the translation of what the company's trying to do is clearly demonstrated for somebody to be able to read and see. And I think an investor relations firm, in most cases, can help guide that process. It's not a one and done. It's more of a engaging in a process for months to establish that mission, to critically pinpoint what your target audience is. It could take you a year to find your target audience. And as an example, one of my colleagues was an ex-banker and went to a microcap company, and his impression was he was going to be presenting at a major investment bank conference, but he was running a 25 million market cap company. That's unlikely. You've got to marry the same type of investor interest to that type of company that you have, because the buy side at one firm might say, I'll only invest in companies that are 150 million plus, and you're a 20 million market cap company. So that's just one example that I see. So to align those issues, I think it's important. I think we need to talk around. Our team is helpful in guiding some of that. And I'm sure that for a few phone calls away, you can have some conversations and establish your own map. Once you have your map, again, you got to start executing. You got to make some mistakes and find the right people that'll buy your stock.
And Sarah,
I want to underscore that, Gene, because I think what Andy said is really valuable. Like our clients, we see using a wide variety of IR firms with a wide variety of specialties, and then they'll be sometimes happy with it or sometimes not happy with it. And I think the way Andy characterized it is right. Depending on what your goal is and your focus and the types of investors you're trying to find or folks to trade your stock, you've really got to match that to the exact specialty that IR firm has. And that's the way you're going to get the good result.
What about secondaries? There are firms that help you do a Reg A. Can I do a Reg A? If I'm already trading, I need some more capital. What can I do? Can I do that, Sarah?
You can. One thing that I would always say is, once you have listed or quoted, you lose a lot of your ability to set the price of your offering. And one of the things that we've seen again and again through this market, and I see that there's a question on this as well, you can establish the price that you go out with your CF or your A, and then you establish a new price, but it was you who established that price. It wasn't the market who did that. And the market is a very unforgiving thing. Once you are out there and traded, if the market says that your shares that you went out and sold at 10 are now worth 2, if you're going to do a secondary or follow-on offering, 2 is where you're going to start. It's not 10, and that's something that's happened with this market in general. Is the price discipline. We've seen some extraordinarily optimistic pricing in the Reg A space. The market imposes its discipline, but in this market it tends to impose that discipline after the Reg A has happened.
Don't I need to?
I think we've seen that with investment banked offerings too, though. I mean, pricing and offering, right? It seems to be something that's challenging, especially within the last year. One of the cool things that we have seen is companies like Trust Stamp or Dragonfly, while they're doing their marketed raises, if the messaging is right, if they've differentiated the raise from the publicly traded security, well, you're spending a bunch of money on marketing IR type functions anyway, and we've seen the stock price go up while they're doing the retail marketed campaign. So lots more left to explore there. We're only in the second inning of this as this category grows, but some really exciting things for issuers who are doing this right and getting their story right.
This sounds awful complicated, and my platform's got this ATS thing where I can put my shares right there, and they say that people are going to buy my shares from there, and I can buy and sell my shares there. Is that a viable thing to do? What's your opinion on that, anybody?
ATSs, I think there's the market liquidity thing is a bit of the challenge. That's why I like the OTC option.
Don't you have to have some buyers if you post it on the platform's ATS?
Right, exactly. So I think that, from what we've heard from issuers who go that route, that can be a bit of a challenge.
And by that you mean it's not a great idea. You really, if you want to do it, you should do it right?
That's what we see majority of our issuers doing, yeah.
The people that have gone listed, Rebecca, have they been happy, or have they come back and say this is a terrible thing, I wish I'd never done it, or gee, I wish I'd done it long before now? I mean, take the temperature of people. What do you get from most of the people?
I don't know. I mean, the vast majority of our issuers are going public, so a traditional stock exchange OTC type listing. And I don't think I've heard any of them say they regret that path. They think it through. They do it when the timing's right. They speak to folks like Andy and Joe and make sure that they're doing it with the right reasons.
Well, I see a question coming up here, which we could probably get to some of our questions now because we got 20 minutes left. And they want to know about the costs. And the costs of always, it depends. So what can we get an idea from someone? What if I just finished with my offering and I'm thinking about listing, what should I put in the budget? Anybody want to take that?
So from the OTC, the nice part about OTC is that in terms of listing costs, they're all fixed and flat. So we have 3 markets we operate: the OTCQX, the OTCQB, and the Pink market. The top two have listing criteria and have annual fees. The annual fee for QB is roughly $15,000. The annual fee for OTCQX is roughly $24,000. But those fees are flat. A large bulk of the fees, when looking at going public, come more on the audit side and probably legal disclosure side. So I'll kind of stop there, and maybe Sarah or Rebecca may want to chime in a bit.
Yeah, one thing I could say is from the legal side, there are a number of qualified law firms. It would include us, since many of our Reg A clients have taken this route. And we have what we think are very reasonable fixed monthly costs for nano companies who are either listed or quoted and who are public. The big thing is the auditors. I don't see anybody I don't see a CrowdCheck law equivalent in the PCAOB auditing firms, and it would be nice if they did, because companies are forever going to the SEC and saying it's too expensive to be public, and they're right. We are trying to help with that. Would like to see some auditors in that space doing the same thing.
I wanted to add that a lot of companies that are very organized with solid and good business plans can really trim back some of the costs by being prepared when you have to prepare an MD&A or other parts, rather than having to hire an attorney. And I hear this all the time, and Sarah might chime in, is that a company went to the lawyer and they got charged per hour because the lawyer had to draft the entire MD&A and kind of almost regroup the whole company to put the company on a track to be creating a message for what investors need. We do see a lot of companies that wait to have a good plan that can come to market with a little more ease. I think that we at OTC Markets, I think, we take out the cost and complexity versus a full listing. And I think a lot of companies want to shoot for NASDAQ in New York, and they're great markets. However, the timing's got to be right and fit the size of the company. Last year we sent several hundred companies and graduated them to New York and NASDAQ. At the same time, we face a lot of companies that get delisted and they come into our space, and yet they still incur all those SEC reporting costs. So, I think that it's kind of like junior varsity to varsity. You kind of you've got to manage that. And I think some companies that are small are nimble, but I think they get thrown into the frying pan when they talk to some really harsh investors, and they might not be prepared to do that. They get a taste of that in raising capital, but I think that, you go to some of the conferences and they're not prepared. And I think this onboarding process, stepping through OTC, QB, and QX, which are established public markets, and all that information can roll up into an S1 if you're going to go to a NASDAQ, helps ease the pain and provide the boot camp, that you really kind of need to go. And a lot of that's from what I've seen, and some of that's my opinion, but the process is onboarding. So I don't know if any of my colleagues, Becca or Sarah, have any comments to add to that.
Yeah, I totally agree about the, being prepared and being able to do some of this work internally. To take, as you said, the MD&A, the management's discussion and analysis, it's not Sarah's discussion and analysis, it's the management's. And so rather than playing 20 questions, like what's your biggest challenge? How much do you think, this expense or that expense is going to change over the years? Start thinking about how you are going to tell your story. As the SEC says, MD&A is not your financial statements in paragraph form. It is the management's explanation of where they're coming from. And that's where a very important story is told. You can't just dump it on the lawyers. You're going to have to take responsibility, and you'll save money that way too.
Sarah, don't I need a lawyer an attorney to continue if I'm traded? I mean, people, I keep reading about these people that are getting in all kinds of trouble, saying things to the public and everything. How do I make sure none of my employees come out and tell everybody they're going to get rich if they buy our stock and stuff like that?
Have a good attorney, but use them sparingly. You do not need, you don't want somebody who's going to over-engineer stuff. You are in control of your own destiny. You can't do this completely without a lawyer. You've got to have lawyers in this space. But you do not have to pay them a fortune.
And I could get in pretty serious trouble with certain publications and releases and things like that if they're not looked over, right?
Yeah, or if you have a good attorney, they will help you develop your own instincts for what you should and you shouldn't say at any given time.
Would you say that they should read every release and every public release that I go out and do?
It depends. Not if it's about, a new product, probably not. But that's really getting into the nitty-gritties. Just use your lawyers wisely.
If you set up an internal policy, right, then you can benchmark it against that, and then when you have to go external and when you're within the guidelines.
Now, Rebecca, there's a question here for you about, are you interested in acquiring other companies that may or may not be secret information, but I think they want to take your temperature on that because it seems like there's consolidation going on in the various companies that are in this field. Well, you got any feelings on that?
Yeah, from Homer Simpson. What I really want to know is who that is. But no, I think I've said it publicly before. Definitely acquisitions are part of our strategy. So you can expect to see more of that from us. We did the acquisition of Reach in March, and that was phenomenal. And we're having a great time getting them integrated and getting the service offerings all streamlined. So expect more in the future.
John, I knew Jonathan Stidd from before as being one of the top marketers in the entire industry. You couldn't get him to take your offering. I think the reason he was so good was because he was so selective. He only took certain certain issuers.
And that's how he has to be. He has limited capacity, so he's still that way. But our goal is to build his knowledge into the tech and allow everyone to benefit from it.
Now, when a company comes to you to go through this process, do you look at them as a future publicly traded company, or are you extremely selective and only take certain companies? I mean, what is your selection process for Dealmaker?
Oh, no, generally any company subject to meeting diligence standards and background checks can come and use the technology. And, of course, that's, as I said, subject to making sure they're compliant. And if they're working with, counsel like Sarah, then we have a lot of confidence in terms of someone taking them through the process who can help spearhead them through the correct processes as well.
And Andy and Joe, you I'm sure people would love to know what are your plans for OTC and how do you see it changing in the future? And what would you like to change about the industry to make it better or easier? What are some of the things you'd like to see? And what are your future plans?
I think, Gene, with the rule change going into effect last year with 15C to 11, it's changed our market a lot, even in only a year. It's cleaned up our market a lot in even over only a year. But looking at, IPOs, crowdfunding, Reg A, we do expect to onboard many more smaller companies, going forward. I do think NASDAQ and New York are kind of going more and more upstream, which is fine. But in terms of this small to micro cap,
Upstream means bigger companies.
I think, I say focus more on the bigger companies. I think they've
Okay.
lost focus for the small cap companies for quite some time now.
Mm-hmm.
But nonetheless, I do feel the rule change, is really good for us at OTC. We now control the mechanics of the IPO process, the timing of it, and it will allow us to onboard more companies onto our market. To Sarah's points earlier, just overall about crowdfunding and Reg A, going public does require, both initial and ongoing disclosure. The Reg A template is already built into that, both initial and ongoing. Crowdfunding, though, is much different, where the initial and ongoing is not really built into being a public company. So for those listening on the call that have, say, done a crowdfunding, or have gone through it or plan to go through it, you just know that in terms of an exit and kind of, well, the question I think I saw earlier was, why would a crowdfunding company list OTC? It's for an exit. It's for liquidity. It's kind of get your money back, right? The only other option really would be to eventually wait for a NASDAQ IPO, or some other, kind of merger or buyout. But, like I said, I think the rule change was going to do a lot for OTC. It puts us in control, and we look forward to working with more and more small private and public companies.
And to that effect, I want to mention what we have an issuer right now doing is doing a direct listing, right, in conjunction with a Reg A. So excited to see the results of that. There's a lot of new innovative structures our issuers are bringing to market.
Yeah, some I've heard some people think of OTC as a stepping stone to NASDAQ. How often do companies just stay with you?
So do you want to comment, Andy?
I'll let you go ahead first, Joe.
No. So, I mean, traditionally, historically speaking, we usually, get about 60 or so, graduates to the exchanges each year. But more and more, since I've been at OTC, we get more and more voluntary transfers, back to our market each year. We are the lower cost, option. And again, going back to, small company and what their needs are, many don't need NASDAQ as they did, 10, 20 years ago. Many kind of fulfill their needs as a public company on being on QX or QB. But to your point, Gene, yeah, there are about 60 or so that leave us each year. And there are about probably a dozen or two that will come back to us from the exchanges equally each year.
That's great. That's great.
Yeah, I was just going to add that cost and complexity, it's one thing to join the gym. It's another thing to stay fit month after month. And I think that the funding is critical to a company's survival, but then you have to maintain that process. In our secondary market, we've had quite a vibrant group of community banks that have continued to raise money through Reg A for consolidation, for expanding their business plan. And some of these vary 7 to 12 million raises continuously, and they're teed up for that. So I would just say that there's a place for our market for a lot of microcap companies. And one footnote to what Joe mentioned earlier about the changes in 15C to 11, OTC Markets really, for companies that were not current in their disclosure, we moved down over 2,250 companies, 2,247 companies to the expert market because they weren't current in their disclosure. It really cleared out and segmented a lot of companies that will not have a public quote, and you cannot have trading in those unless you're a sophisticated trader and your brokerage house allows you to trade in that. That really moved away, really set some tiers in a much more understandable way for many trading and investors, because you have QX which is financial standard corporate governance. You have QB, which are corporate governance. You have Pink, which is an open market. Those three tiers are current in their disclosure. And a lot of the ugly got moved off because for a variety of reasons. And we continue to monitor the companies that are there. So it's more manageable for a lot of companies to remain there until they can graduate and take on the expenses. But the ongoing complexity of maintaining being public on a national exchange isn't just about filing a Q and a K. There's more to it than that. So we encourage companies to do that, but they wait. Sometimes the wait is better to onboard up to an exchange at a later point.
Let's give everybody a way to gather more information. I know, Rebecca, your website is dealmaker.tech, dealmaker.tech. And I suspect you have things on your website where people can gather more information about your company and about how Dealmaker could help them. Is that correct?
That's right. We have some case studies there as well. So if you're an issuer considering it, you can browse those and you can submit a question through the form or email us at info.dealmaker@dealmaker.tech.
Great. And Sarah, I know that you have a very informative website about the rules and regulations and all these things. And people can go to crowdcheck.com. Is that correct?
That's right. And they should look at the blog and they should look at the resources section.
It's fabulous information. You can almost become a securities attorney if you spend enough time there. So, and then Andy and Joe, your website is OTC Markets. Do you have any informative information that people can get?
Yeah, sure. OTCmarkets.com. We have a section, how companies can qualify and be reviewed for qualifying for OTC QB or QX. We have our eligibility standards. We have our disclosure standards. And there's more information around there about how to get traded, things of that sort. So it's quite comprehensive. But if anybody wants to send an email, I think our emails are available. If not, it's andy@otcmarkets.com. We're happy to follow up with anybody that has any questions afterwards.
Terrific. And MediaShares has a 15-page document that you can download from the home page. There's a little thing on the right corner, say download the document, MediaShares.com. A downloadable 15-page document on equity crowdfunding and different platforms and different marketing expenses and things like that. It's very informative if you care to go there. And I think although we've got 5 minutes left, I think we've pretty much answered everybody's questions except for one, and that is that a recording will be available. And so we want to thank all of you for coming today and taking your time to talk about crowdfunding exits, which is something that's needed because a lot of times companies they don't really have a plan. And investors have had people call me and say, what about the shares that I bought in this company last year? What can I do about that? And so this is going to be a very informative document that we'll be able to send out to people. So
great. Well, thanks for organizing, Gene.
Thank you all. Wonderful, very valuable webinar, I think. And we'll see you next time.
Thank you.
Yep. Thank you, Gene.
Bye-bye.